You know the drill. It seems like every few years, the same story hits. The headlines start screaming, the news channels go into a frenzy, and it looks like Washington, D.C. is about to grind to a total halt over a government shutdown. The panic feels real, right? The stakes feel huge. But, while all of us are watching this political drama unfold, to financial markets, well, they're telling a completely different story.
So, let's just cut right to the chase. You hear those words, government shutdown. Is it time to hit the panic button on your portfolio? Should you be bracing for a market crash? Well, the historical data suggests something else entirely. So, let's dive into what's really going on here.
What we're really looking at is this fascinating paradox. On one side, you have a real-deal political crisis, and on the other, you have a financial market that a lot of the time just seems to shrug. So, in this explainer, we're going to unpack exactly why Wall Street yawns while Washington completely panics.
When you really dig into the data, you see this critical separation, this decoupling between all the political games being played in D.C. and the actual fundamental health of the market. And the reason is pretty simple. You see, the big institutional investors, they've seen this movie before, and they've learned that the ending is almost always the same.
And believe me, this isn't some new thing. While these funding gaps have happened for decades, the kind of modern, high-stakes shutdown we know today really started to take shape after 1980. We saw these huge battles in the mid-90s, another big one over healthcare in 2013, and of course that record-breaking shutdown in 2018 over border wall funding. They've basically become a recurring and frankly almost predictable part of American politics.
All right, so let's get into the first big piece of evidence, stock performance. This is where the story gets really counterintuitive, because while you'd expect total chaos and massive sell-offs, the numbers, well, they paint a shockingly positive picture.
Okay, so let's just start with the 16-day shutdown back in 2013. The government was closed for business, political tensions were absolutely boiling over, and the S&P 500? It went up 3.1%. The market didn't just ignore the crisis, it actually gained ground while Washington was at a complete standstill.
And it gets even more dramatic than that. During the longest, most bitter shutdown in U.S. history in 2018-19, the market didn't just hang in there, it thrived. The S&P 500 put up an incredible 10.3% return. This isn't just a fluke, it is a clear, undeniable pattern.
But this resilience isn't just about what happens during the shutdown. Let's zoom out and take the long view. A full year after a shutdown finally ends, the S&P 500 has been higher an incredible 86% of the time. The market doesn't just recover, it's like the resolution acts as a launchpad.
And the average return in that following year? A massive 16.95%. So what does that tell you? It suggests that the savvy investors, the ones who've been around the block, see these politically driven dips not as a threat, but as a sale. A temporary discount before everything gets back to business as usual.
Okay, so stocks are surprisingly strong. Got it. But what about the rest of the market? Let's take a look at bonds and volatility, because that tells a much more detailed story about how the really big players, the institutions, behave when this stuff happens.
What we see isn't a sell-everything mass panic, not at all. Instead, it's a very deliberate tactical shift. The big money moves into what it sees as the safest asset on planet Earth, U.S. Treasury bonds. It's kind of funny, isn't it? Even when the U.S. government is partially closed, its debt is still considered the ultimate safe haven.
And this leads to this really wild paradox. You'd expect all this chaos to send the market's fear gauge, the VIX index, soaring through the roof. A high VIX means high anxiety. But what happens in reality? During the last two major shutdowns, the VIX actually fell. Investors were moving to the safety of bonds, sure, but they weren't actually panicking about the future.
The numbers really back this up. The VIX dropped over 12% in 2013 and nearly 15% during the 2018-19 shutdown. And at the same time, because everyone was rushing into bonds, the yield on the 10-year Treasury fell. This combination, falling fear and a flight to safety, shows that the market has already priced in the political risk. It sees it as an expected, manageable event, not some out-of-the-blue crisis.
Now, this part is absolutely crucial to understand. Just because the stock market is resilient, it does not mean that these shutdowns are harmless. The economic pain is incredibly real, and it really shines a spotlight on this massive disconnect between the experience of Wall Street and the experience of Main Street.
The real-world cost is just staggering. For every single week the government is shut down, the U.S. economy loses an estimated $7 billion in output. That's real money, real jobs, and real services that just, poof, disappear.
And this gets right to the heart of that disconnect. Professional investors, who are looking at decades of data, see a short-term political problem that they know will eventually get solved. But for the public, for federal workers, for small businesses that depend on government contracts, it feels like a very real, very immediate economic threat.
And you can literally see that feeling in the data. Just look at what happens to consumer confidence. It absolutely plummets. In 2013, it dropped 8 points. During that longer shutdown in 2019, it fell 10 points. So while the market is staying calm, the public's faith in the economy takes a massive direct hit.
The pain also isn't spread out evenly across the economy. There are clear winners and losers here. Investors flock to sectors they see as being insulated from the drama, like defense and healthcare. They actually tend to do pretty well. But if you're in an industry that's right on the front lines, like travel, you get hammered. We're talking $1 billion a week in losses as national parks close and people start canceling their trips.
So what does all this mean for an investor? How do you take all this data and actually separate the valuable signal from all that distracting political noise? Let's bring it all together.
The single most important takeaway is how to correctly classify a shutdown. Based on all the evidence, it's a high-visibility, super dramatic, and short-term political event. It is not, however, a fundamental economic crisis that's going to change the long-term direction of the market. So, for any long-term investor, the lesson is crystal clear. Focus on the things that actually drive the market, what the Federal Reserve is doing, what inflation looks like, and what corporate earnings are. Treat all the political drama as temporary noise. History shows us that market resilience is the rule, not the exception, and that any shutdown-related dips have often turned out to be powerful buying opportunities.
And that leaves us with a final, bigger question to chew on. The market, which is really just this massive collective intelligence, has essentially learned to ignore these political fights. It has priced in the dysfunction. So if the financial world has figured out how to separate politics from the economy, what does that say about the real-world impact of our modern political crises? It's definitely something to think about.